People are just panicked. This is the first day I'd say where I'm actually sensing that panic in investors. I wish I could be more optimistic, but it's a scary time right now. If the Fed had bullets in their gun to get us out of an issue, I wouldn't be so worried about it. It's like, okay, well then they could come out and print again. But I do worry that we're going to see that protracted bear market, like long-term bear market. The key here is to just understand what type of market we're in. When you're in a bear market, it takes a lot to get price to go up because people are scared, right? So, if you're in a bull market, you could have the tiniest bit of news and price will rip up. It could even be news that's not relevant. And we've seen stocks like GameStop and AMC. I mean, all these things just go to the moon. But the problem is we're in a bear market, and in a bear market, people really need value. They need to know that something is immediately changing, and the merge isn't doing that, right? Yes, long term, it's probably fantastic for Ethereum, but in the near term, what is everyone focusing on? The Federal Reserve, interest rates, the US dollar, the economy, and all of those things are just crushing risk assets right now. So it was kind of a no-brainer to me that you saw a kind of an early front-loaded run up a few months ago, and then it just kind of came right back in. I've kind of been in the conservative groove where I'm saying to myself, all right, the Fed needs to be careful here, because if they do tip us into a bad recession and inflation is still above the 2% mandate or 2% sub-mandate, then how do they get us out? The markets are going to look towards the Fed and say, hey, could you mind printing some money and get us out of this like you have for the past 20 years? And the Fed's going to be like, can't do it. We don't have 2% or under inflation. We can't print the way out. And I think that's starting to kind of have an impact here, where the Fed is just so hawkish and just kind of gangbusters ahead. It almost reminds me of an emotional reaction. They know they messed up printing too much prior. Now they're trying to make it up with another wrong, and two wrongs in this case do not make a right. So the markets are headed down. I think we're oversold near term, so it wouldn't shock me to see a bounce next week. But at the same time, I still think the COVID highs just before March of 2020, that has the target written all over it by year end. And again, that's at around 3,385, so 3,385 on the S&P 500. What's going to happen is you're going to have this pivot come with the Federal Reserve, where the economy starts to significantly weaken. They step to the sidelines and they stop raising rates, and the markets are going to cheer, and you're going to see a massive bounce, probably off that February 2020 level of 3370 to 80. The problem that's going to be, and the next leg down that takes us to 3,000 or sub 3,000, is a few months later, we're going to realize how bad the recession is. And then we're going to turn to that Federal Reserve and say, Jerome Powell, come save the day. And the Fed is going to say, can't do anything, guys. We have inflation that's too high. And that realization, I mean, think about the addiction of the markets over the last 20 years to this. The Fed always bails us out. I mean, in 2018, the Fed just threatened to basically raise rates. The S&P and the NASDAQ dropped 20%, and the Fed quickly reversed and started printing money again. And that's the market that we've been in, where the Fed is like the parents always protecting the child. Well, guess what? The child is out of the house now. It can't be protected anymore. You can see we bounced off these pivots right here. All right. And that's going to be a short-term little bounce. And then eventually we're heading back to basically just below 1,000, the double bottom. And then if I'm right that Bitcoin is headed to 12 to 13,000 and maybe even below, then I got to think that Ethereum could easily be headed down to 700, 600 area. You see, you're basically just hugging a little bit of support right here. If the dollar continues to strengthen and the Fed seems to want to make sure that it does, then you're going to break this 18 to 19,000 level, and your next stop is not really until that 12 to 13,000 level. That's my best case. That would be if everything works out and everything is fixed and so forth. Worst case, you have to look back to the .com era when Amazon dropped 95% during that collapse. And if that's what crypto's going through, you could be looking at a $3,500 worst case scenario target on Bitcoin. Every time you get a new candle on the daily chart, it's a new piece of a puzzle. And a good technician is going to go and look and say, okay, does this change my thesis? Does this change anything? And really what we've seen is the Fed's gotten more hawkish. The economic outlook for me is even more bearish based on the Fed being more hawkish, and that you have to start lowering asset prices even more. Basically telegraph 75. The markets had priced that in. What it was when they came out, they raised expectations for the next few hikes. And that's what shocked the market. So it's almost like a stock reporting earnings, right? So the earnings came out in line, but the Fed raised guidance on interest rates. And that's really what kickstarted the selling pressure, because then the dollar took off. Look at the 10-year yield. I mean, the 10-year yield is above 3.7% now. The 2-year is well above 4. I think it kissed 4.2%. That's an incredible inversion and a very scary thing. And one thing that I think, and again, it blows my mind the Fed's not kind of talking about this, or maybe not aware, but when you go back to Volcker back in the 80s, he kind of had this stutter step where he raised from 12% to I think about 18%. That's about a 50% hike in interest rates at the time. Now think about the difference in interest rate hike percentage wise from where we were until where we are now. We were basically at 0, and now the Fed has us what, at 3.25? I mean, percentage wise, this is an enormous hike, way more than Volcker back then. And it's going to have a major impact on the economy. And again, this is what scares me about things is like, you know, it's one thing to say, oh, you know, if we go into recession, the Fed can save the day by coming in and, you know, doing what they've done. But if you have inflation that's sticky around 4 to 5%, which is what I think it's going to be, how do you get us out of it? And are we going to be in a protracted, a long-term bear market? You want to let the economy digest these rate hikes. And I think that's the major issue here, is that the Fed is doing them one after the other, 75, 75, 75. And you're not giving time for it to cycle into the economy. So for all we know, in 3 months to 6 months, when all of these hit the economy, we could find ourselves in a nasty, nasty recession. And again, that's what I think the market's getting skittish about. You can see the dollar is skyrocketing again today. That's putting pressure on risk assets across the board. And again, there's this kind of, it makes me think that the Fed is trying to reestablish credibility, but it's almost like they're doing it in the wrong way, right? They're not doing this measured, methodical approach. They're just saying, you know what, we got to punish the market because you guys expected us to be lenient forever. Now we're going to really kick your butt and show you that we're not. And I think that's really dangerous. It is a wacky situation. And it reminds me of almost going back to 2008, where things started to break, right? Where we started to have the derivatives market and all of these different things start to break down. And again, if the Fed is watching, be really careful here. Almost every single day, and I pay attention to the stock market and the news. There's always there's a new company that says, hey, we're going to lay off 10% of our workforce. We're going to cut X amount of spending, and all of those will loosen up the labor market a little bit. But I think the key is that it doesn't negate the shock that we already saw, where people at McDonald's or people at these different places are now getting, you know, double what they were getting, you know, $25 an hour or so in salary. Now, you're not going to see those salaries go back down. They may not continue up, but they're not going to go back down. And so you have these businesses that have to figure out a way over the next few years to kind of come back in line with the margins that they had before. And that's where you get this kind of stickier inflation that doesn't get down to this 2% or sub 2% mandate. And I think it's going to be a very scary situation when again, we do see the Fed continue to raise and push us into a recession, and then they're not able to get us out. And you could just look at stocks or markets like the Chinese stock market, which went from 2003 to 2008. They had this monstrous run, much like we saw over the past 5 years or so. And then since then, it's been in 10 years, actually 14 years of sideways chop. If you look at the Brazilian stock market, same thing, had a huge run in the early to mid 2000s. And then since then, those markets have just been up, down, not making new highs. And I think that's something that US investors are going to have to get used to. Now, as a swing trader, it's a good market. You get the swings intra move. As an investor, it's going to be a tough market. The Fed really pulled forward a lot of the upside. I think you want to look for a Fed pivot. The Fed pivot will be positive in the near term for risk assets, including Bitcoin. And I think that's where you start to nibble. I'd strongly encourage your friend to kind of not go all in at that level, but instead just dip a toe in the water, If it drops a little bit more, do another toe, kind of do that. Because again, we just don't know, this is, remember, Bitcoin's only been around for now 13 years. It's a baby of an asset, and we just don't have enough data to really know for sure how it's going to behave. There's a point where you start to get closer to a bounce in a stock in the markets, and this could be any market, where people are just throwing everything out the window. And I think that's what we're seeing today is you have interest rates that are just freaking people out. The dollar just keeps ripping up. That's freaking people out. And people are just saying, you know what? I'm exiting everything at this point, and I'll ask questions later. Now, we will probably see things like gold start to recuperate faster like we did during the COVID collapse, but that's what's happening right now. People are just panicked. There's definitely, this is the first day I'd say where I'm actually sensing that panic in investors, and that means we're getting closer to a technical bounce. There's going to be a point where they break the economy, and we're going to start to see it in some of these economic numbers. I don't know if it's the jobs number or if it's the next CPI number or what it is, but there's going to be a point where the economic data weakens, where the markets start saying, you know what? We don't think the Fed will raise as much as expectations are telling us. And that's that pivot where the dollar starts to roll over. I wish I could be more optimistic, but it's a scary time right now. If the Fed had bullets in their gun to get us out of an issue, I wouldn't be so worried about it. It's like, okay, well, then they could come out and print again. But I do worry that we're going to see that protracted bear market, like long-term bear market. And I do think that that's going to be an issue for people and for unemployment for the longer term.